All right, I think we are good to go. I have everything set up. Happy December. Can you all believe it's December? When did this happen? Okay, but there's snow, and I'm ready to go back to North Carolina now. Y'all did not prepare me adequately for the snow. I'm just saying. But as usual, we are going to be doing some national review questions. If you have a specific question, you just need to let me know. So let me share my screen. Do, do, do. And we will be off to the races. Why do we say that? I don't know. I'm sure one of you all knows, but we're going to be off to the races. All right. So we've got this. I've got this set up. I've got this set up. And I think we are good to go. Let me know if something is wrong. We left off on a number 74 last time. So let's do number 75. A number that relates to net operating income to value is. A number that relates to net operating income to value is it A, the gross rent multiplier, B, the capitalization rate, C, the depreciated cost factor, or D, the effective gross income factor? Well, we got to figure this one out. It sounds like one of those SAT or ACT questions. You know, moon is to sun as fire is to, I don't know what the opposite of fire is, but whatever that answer would be. Yes. All right. So, Amy, you say it is B. You say it is B. Okay. Why? Caroline says, well, what? Why? Why is it B? A number that,
Because,
go ahead.
because it's using the income approach,
Yeah,
right? And so net operating income and value and the cap rate are all part of that. I mean,
exactly.
yeah.
Because if we take the NOI and we divide it by the cap rate, you find value. So this cap rate is relating the NOI and the value. So you need the cap rate to find the value if you have the NOI. So yes, I do love that as an answer, right? But the question is, as you go through and study, are you sure and are we feeling, hey, Trix, I see you there in other land. Are we sure that we know what the gross rent multiplier is? Remember, we're taking that GRM and multiplying it by our rents to get value, right? And then your depreciated cost factor, maybe that's a real thing, but doesn't sound familiar to me. And the effective gross income factor. Well, you can have an effective gross income, but this factor is there. Marissa, you passed your test a while back. Oh, yay. Oh, you are so welcome. And of course, you get your song. So here it goes.
Good job, good job. Good
Good job.
job,
Good
good
job.
job. G-double-O-D-J-O-B.
Good
Good
job.
job,
Good
good job.
job. Hey. Yay. I am so proud of you. And you also get.
My money don't jiggle jiggle, it folds. I like to see you wiggle wiggle, for sure.
We love it when you pass. We love it when you pass. So I love that for you. Yay. We love it. All right. Yes, she did earn her song. She most definitely earned her song. I can't wait to play it for all of you all. So we are good with number 75, that cap rate. Guys, we know they're going to test you on that. That's one of those, don't go into the exam unless you know that you know this thing. It's just something they love to test you on. I don't know why, because most people are going into residential. Who cares? But since they're going to test us on it, we need to know it. Number 76. Which of the following does not fit in the group? Okay. Which of the following does not fit in the group? A, Consumer Credit Protection Act. B, Truth in Lending. C, Regulation Z. And E, Equal Credit Opportunity Act. I see your tricks. Do a little dance, do a little dance, do a little dance, do a little dance. All right. Which of the following does not fit in a group? Consumer Credit Protection Act, Truth in Lending Act, Regulation Z, and Equal Credit Opportunity Act. What are we thinking? Well, I know Truth in Lending and Regulation Z, TILA and Regulation Z are basically the same thing. These are basically the same. I use them interchangeably because they're same. Okay, so we got some people saying A. Why would A not fit? What's about A? Why does Equal Credit Opportunity Act fit to the group, but Consumer Credit Protection Act? Why is it different? I think that you all know you're going to see, and you've heard me talk about it, Truth in Lending, Regulation Z, Equal Credit Opportunity Act. Those all have to do with closings and what happens with what you have to be told and getting a mortgage. The Consumer Credit Protection Act, A, I'm not even sure if that's an actual act. And B, it doesn't fit in. It doesn't go with our closing mortgage stuff. So yes, I'm going to go with A as well. Consumer Credit Protection Act. Is it a real act? We'll figure that out another day. Put a little note there. All right, 77. A person buys a furnished house and wishes to finance the purchase of both the house and the furniture on the mortgage loan. She tries to get. So yes, you have the answers there in front of you. But if you know the answer, then go ahead and even before you read, like when you read the question, you're like, oh, I know this. If you know that vocab word, then go ahead, write it down, and then look to see if you have something that matches. But our options are a blanket mortgage, a purchase money mortgage, a temporary loan, or a package mortgage. All right, we got a D, Caroline. Miss Confident Caroline says D. Hey, Nino, you said A in the last one. Hello and welcome. All right, we got a D for package mortgage. Well, I like D. I do like D, but I have to make sure that I know what the other things are as well. Right. And I will say, you all know I passed my Michigan class exam, but as I've been studying for my state exam, like my actual licensing exam, I've kicked it up a notch because I really kind of don't want to fail that the first time. And I'm doing the same thing you all are. I'm using these questions that I'm getting from different sources for specifically Michigan, but for any of the topics, and making sure I understand not just what's the right answer, but why are the other answers wrong, slash, do I know what they are? Right? So, yes, our answer is package mortgage because we've got both the house and the furniture. You are using as collateral. You're using as security. Kind of like when you go to the the people, the pawn shop, and they give you money and then you give them like some collateral so that you come back to pay them back. You're using the house and the furniture, personal property as collateral. Package mortgage. I like to think of packages on Christmas Day that you get, right? Trix, I see you. She said D's nuts. But a blanket mortgage, remember, covers more than one lot. That's a E. You just can't tell. A purchase money mortgage is where the seller is financing. And a temporary loan, I got nothing on that one. So yes, D. Ah, Trix, you said you just got the PSI study kit and the practice test because the language is so different. And the language very well could be different as long as the information is the same and you're able to read through it and figure it out. Like if you're able to say, okay, what does this mean? But yeah, I think the PSI is a good thing, either PSI or the different one, Pearson VUE. It's good to see those different things. All right, 78. Which of the following is not a typical obligation of the mortgagor? Which of the following is not a typical obligation of the mortgagor? So one of these, first things we have to look at is, okay, 3 of these are obligations and 1 is not. So we're going to have 3 trues and 1 false. And then the mortgagor, who is the mortgagor? Ooh, it's on a Cyber Monday sale. Trix is telling us that the PSI practice questions are on a Cyber Monday sale. Hey, if they're inexpensive enough, I suggest everybody get them, try them, right? You said your college books were outdated. Girl, it happens. So who is the mortgagor? Who is the mortgagor? Is the mortgagor the borrower? Or is the mortgagor the lender?
The borrower.
It is the borrower. Yay. There's our confident Caroline, because the borrower, the or is the person giving, and the borrower is the person giving the mortgage or the deed of trust. So what is not something the buyer typically does? So we're looking for what the buyer doesn't do. Did I just rewrite the question in the sidelines? Sure did. All it matters is that I get it right. So, who maintains the property? Who has to keep a hazard insurance policy in force? Who has to get permission for alterations? And who has to advise the mortgagee of a change in escrow account balance? All right, so we're looking for something the borrower doesn't normally do. So who usually maintains the property when there's a mortgage? Well, the buyer does. The new owner does. You buy the property, but you borrow money from the bank, and the bank is expecting you to maintain the property so that if they have to foreclose, it's worth something, right? So yeah, that's not our answer, because that is something that the buyer does do. That's a true. Who has to keep a hazard insurance policy in force? The buyer. The buyer, that's what we got that PITI for, right? The buyer has to have the T and the I. They take the taxes, they take the insurance, they put them in an escrow account, because again, the bank wants to make sure their investment is protected. It's not B. Get permission for alterations. And that is something that the buyer has to do, although a lot of people in real life don't realize this. Just like if I were to borrow Caroline's car, if she let me borrow her car, and when she gave it to me, it was a black sedan, and then when I give it back to her, it's bubblegum pink, and I made it into a convertible, that wasn't my car to make changes to. That was Caroline's property. Well, when you get a mortgage, the bank has such a strong interest in the property. You need their permission before you can make major changes. So yeah, you do need to get permission from the bank, which means our answer has to be D, advise the mortgagee of the change in escrow account balance. That's not something you typically have to do, because why would the borrower be telling the lender there's an escrow account balance change? That's something the lender would know. We, as the borrower, put the money in the escrow, but we don't have control over what the balance is. So yes, our answer is D. Just saying. Just saying. Dahlia, you passed. Oh, we have another one that passed. Another one that passed.
Good job, good job. Good job, good job. G-double-O-D-J-O-B. Good job, good job.
Oh, I love it. And
My money don't jiggle jiggle, it folds. I like to see you wiggle wiggle, for sure.
I want to hit that one more time just because it's so good.
My money don't jiggle jiggle, it folds. I like to see you wiggle wiggle, for sure.
Yes, I'm the coolest person in the club. I need to get a life and better dancing skills. But congratulations, Dahlia. The answer here is D for Dahlia, who passed. Love it. I'm just jamming in my own head over here. So yes, our answer is D. Whew. All right, 7 to 9, which is different than 6, 7. What have the children done to me? I just said 6, 7. Let's give a moment, just a sad moment for the loss of my sanity. All right, 79. I didn't have much sanity to go to begin with. Which one of the following does not affect the interest rate adjustment in an adjustable rate mortgage loan? So which one of the following does not affect the interest rate adjustment in an adjustable rate mortgage loan? So we know this is an ARM. So 3 of these going to have an effect, and 1 has no effect on the new rate. Say new rate, right? All right, we got a B. Muriel says 79B. She says the equity, your equity does not affect what's going to change what your interest rate's going to be, right? So then we've got, let's see, index, margin, and cap. Okay, Caroline, you say B. Well, you're right. You're right. The answer is B. But we got to make sure we understand what all these other things are. So we know the index, that's what they base the new rate on. Right, there's going to be an index, usually a CPI or something like that. Well, actually, no, they used to do it off the Lindor. You don't care. It's all that financial stuff. But there's an index where they basically, and by they, I mean the bankers, the bankers are like, hey, this is what we're going to base your new mortgage rate on. So there's an index. That's not the answer. The margin is the extra money that the bank is charging you over the index. So if the index is at, I'm just making up numbers, 3%, they're going to charge you a little bit more than that. So yeah, the margin's going to affect what your new rate is. That's the extra money for the bank. And then the cap. When you get an ARM, they tell you, hey, yes, your rate's going to be between this and this, but it's never going to go higher than this number, and it's never going to go lower than that number. So yeah, I don't know. I mean, not that I want this to happen, but if interest rates were to spike up to 11%, your ARM would have had a cap that said, hey, when you first got the ARM, it was at 5%, but it was never going to go above 9%. Doesn't matter if the index is at 11, the most yours would be 9. So yes, that cap is going to affect your interest rate. So 79, our answer is B. Yes. They put a cap on it. Yep, exactly, Miss Caroline. No cap, as the kids will say. 80, in a fixed rate amortized loan, which one of the following does not vary from month to month? So we got they're doing a lot of these nots in this one. Which one of these does not vary? So that means 3 change each month and 1 does not change. Let's see our options here. Our monthly payment, does that change? Our interest paid, does that change? Our principal paid, does that change? Or the remaining principal owed. All right. So, Trix, I see that you have a B there. I don't know if that's for number 80, but I got Amy. She said C. Caroline said C. Mariel said C. We got an answer of C right here. Do we all agree with that? Stacy said C. Okay. All right. Well, it's a good thing y'all had a vacation because be,
Houston, we have a problem.
that's not it. That's not it. That's not the answer. But let's talk about why. It's okay if we got it wrong. We got to understand why it's not. You said, oh my. And the rest said, we all. So Trick said it was C2. So this, got to look at it. This is a fixed rate amortized loan. So what does that mean? If it's a fixed rate amortized loan, all right? Well, one, we know that the interest rate never changes. The interest rate, when we look at this question, it said the amount of interest paid. That's different. The interest rate doesn't change. But that's not what it said. Remember, what happens is you say, oh, let's kind of do this really quickly. Let's say we had a $200,000 loan. Remember, we use a factor or a dollar amount per 1,000 borrowed. And that's going to be based off of our interest rate that never changes and the number of years or the term that you have it. Remember all this? So then you go to your amortization chart. It's around here somewhere. And where's my amortization chart? How do I have so many things open? Right? So let's just go with this one. At some point, I was doing something at 6% for 30 years. We had $5.99 as a factor. Remember this chart? There's your rates, there's your year. So that's our factor. We're saying you're going to pay $5.99 for every 1,000 borrowed. So there's going to be the $200,000. If we want to know how many thousands there are, we divide by 1,000. So we get 200. So we're going to pay $5.99 200 times. So that means your monthly PI payment is 200 times 5.99 equals $1,198. That's your P&I. But remember, our P&I never changes. So what we know is you owe $200,000 for that first payment. That's how much you owe. And then you're going to pay P&I, and that's your balance, I should say. You're going to pay that first month $1,198. Right? It's month one. And some of that is principal and some of that is interest. And then whatever that principal is, you're going to get a new balance. Does this sound familiar? And I'm going through it quickly just because I know we've done this before. But we would say, hey, for this first payment, and I'll choose a different color. If you borrowed $200,000 at 6% for 1 year, so we're going to multiply it, that would be interest for a whole year, $12,000. Okay, probably should have been able to do that math in my head. That's for a year. And if I divide by 12, that gives me $1,000 is the cost for 1 month. So yes, you paid the bank $11.98, but $1,000 went towards interest, which means the difference, $198, that's what's going to be your principal payment. And then you're going to have a new balance of the $200,000, subtract the $198, and then that gives you a number. And what is that? That's $199,000. Oh, you know what? Not even going to try. So yeah. It's too cold for my brain to math. That'd be 199,802. And then the next month, your balance is 198,802. But you made a payment of 1198. And then this time, I mean, I could do the math, but remember how much you paid towards principal goes up and how much you pay towards interest goes down. Does that sound familiar? Like, I know I just did that quickly because this isn't supposed to necessarily be a math class, but what never changes is this principal and interest amount. That amount you pay that we figured out from the factor based on the number of thousands you borrowed. That doesn't change during the life of the loan. What changes is the split between how much of it goes towards principal and how much of it goes towards interest. So somebody let me know I didn't lose you as I grab some water. Uh-oh, might have lost y'all. Does that make sense to anybody? Does anybody understand? Oh, good. Yes, thank you, Mira. Yes, thank you, Amy. I just wanted to make sure, just a quick review. We understand this. Some of you all, so my North Carolina people, you need to know how to do this math for your exam. This would be what would be your balance after the first loan payment. That's the math I just did. Also, you should know it in real life anyway, but there you go. So going back to our question, that's why our answer is not C, because your principal and your interest, how much you're paying every month, that changes every single month, which means how much you owe because you're paying down the loan changes every month, which means our actual answer should be A, the monthly payment. Good. All right, and Trix, if you need me to explain it slower, I can. We can stay after or whatever, but I just want to make sure everybody understands that. That is the concept of amortization, whether it's a car loan, a house loan, whichever. So want to make sure everybody understands it. Boom. All right, 81. The discount rate is. The discount rate is. Is it A, the amount of points you pay to reduce your interest rate? Is it B, the amount of interest the Federal Reserve Bank charges each other for loans? Is it C, the amount of interest paid on Treasury bonds? Or is it D, the amount of money as a percent of total deposits that the banks must keep in cash? Well, I'm really hoping that y'all know the answer is not C or D. I mean, that's just not what we're talking about in this class. So then the question becomes, is it the amount of points you pay to reduce your interest rate or the amount of interest the Federal Reserve banks charge each other for the loans? Well, our answer is A. Remember, the amount of interest that the Federal Reserve says a bank can charge another bank. So if you're Bank of America borrowing money from Wells Fargo, that is the federal funds rate. So if it's bank to bank, like business to business, that's the federal funds rate. But if a bank is borrowing money from the Federal Reserve, that's going to be the discount rate. Had to think of the name. That is the discount rate. And then the prime rate is the rate that, you know, like Apple would get if they're borrowing money. So yes, our answer is A. Look at that. Nice strong comeback. Getting the next one right after getting that last one wrong. I see y'all. See you. All right, 82. A property is foreclosed and sold for non-payment of the mortgage loan. Okay. The sale does not cover the remaining balance of the mortgage loan, and the bank goes to court to seek what? So the property foreclosed, the person, let's say, owed $300,000, but at foreclosure it only sold for $275,000. The bank goes to court to seek what to cover that $25,000 difference? Is it A, a judicial foreclosure, B, statutory redemption, C, equitable redemption, or D, deficiency judgment? Ooh. Okay, Mariel says D. I got one D going on so far. Well, let me help you out in case you're confused. It's not equitable or statutory right of redemption. Remember, our right of redemption means the owner can fix stuff. They can pay some money and stop this whole foreclosure process. So it's not B or C. All right, Caroline says D, Stacy says D, and of course, Trix is going to give me D's nuts. It's never going to get old. It's never, because yeah, it's D for deficiency judgment. It is D for deficiency judgment. Remember, judicial foreclosure has to do with lien theories, states. That's where it's your house. The bank just put a lien on the property. So if you stop paying, the bank has to go through the judicial system to get the foreclosure. Versus in a title theory state, the bank owns the house. They're just letting you live in it. Hypothecation. And then there's a non-judicial. They don't have to wait for the courts in order to foreclose on the house. So good job, guys. Good job. All right. 83. The term most closely associated with real estate taxes is. The term most closely associated with real estate taxes is A, ad valorem, B, appraised value, C, market approach, or D, cost approach. Okay, we got an A, we got an A, we got an A. Okay, y'all came in. I can always tell when y'all know the answer because it just comes in. A, yo. A. Yes, our answer is A, ad valorem. That means according to value. When you pay real estate taxes, how much you pay is based off of, well, how much do you owe? So there's that. Or how much do you owe? How much is it worth? Sorry, getting that out of my head, just weird. All right. The reason I got out of my head for a second was somebody had asked me if it was possible for me to do like little mini lessons during these. Like, yes, they liked the fact I was going over questions, but they were like, hey, could you like pick a topic or a vocab word and just kind of go over it towards the end of a session. But this is for you all. So I wanted to see how you felt about that and if there is a topic. So like, for example, those people who were in my North Carolina class, if you said to me, hey, Candace, could you go over joint tenancy for me real quick? I'd throw up my slides and kind of go over what we need to remember for that topic on the test. Or if you said, hey, Candace, go over prorations, or hey, go over this. I can pick a topic, but you all just let me know what you are thinking. And I see y'all. I see you, Caroline, with the A for apple. I like to eat. I like to eat apples and apricots. All right. Also, A is for apple, and the assessment ratio is used to what? The assessment ratio is used to. Now, I will tell you right now, I'm like, assessment ratio. And it's not a term that just goes, oh, yep, I know what it is. But I do know that assessed value has to do with how you pay your taxes. Remember, there's the actual market value of a property, but then your state, your city, your county, your municipality says, hey, but we want you to pay taxes off of this value. That value is going to be your assessed value. So I don't even know. I haven't even looked at my answer choices yet. But since assessed ratio isn't just something that I'm going to see if something comes with taxes, right? So let's see. Is it used to determine the tax rate? Is it used to convert market value to value in use? Is it used to convert market value to assessed value? Or is it used to determine property tax exemptions? I'm going to say it's not C. I'm going to say, A. No, it's not determining the tax rate. You don't use the assessment for tax rate. That's what makes that wrong. And we're not doing the value in use. We're doing C. This is what you need to say, hey, you're going to pay taxes based off of this portion of value. So let's say my house was worth $200,000. They might say pay taxes on, 70%. It's a ratio. You're going to pay taxes. Your assessed value is going to be based off of 70% of the market value. So there we go. Nice answer, guys. 85. Someone protesting his assessment has to prove what? Someone protesting their assessment has to prove, is it A, that their taxes are too high? B, their taxes are higher than those of similar properties? C, his assessment is too high? Or D, the assessment is unequal to those of similar properties? I have a thought here, but what are you all thinking? This is a good one. All right, so Maril says B. We got one person saying B. And then we got Amy saying D. So far it's a tie. Kavani, I'd love to hear what you think. Caroline says D. We got another D. What are we thinking? Oh, Kavani says D too. So let's see. Trix, do you have a thought? That sounds awful when I say it. That sounds very like passive aggressive, like what's going on there. But yes, the answer is D. This is a good question. I won't say it's hard, but it's a good question. Why? Because if you're protesting the assessment, look, the county, the city, the municipality could give two craps if you think the taxes are too high. I think taxes are too high. Does anybody really want to pay taxes? No. But it's not about your taxes being too high. When you're going to be able to challenge this is going to be, you know what, the reason my taxes are high, and that's unfair because other people aren't paying as high of a tax. Like, does that make sense to everybody? You're saying, look, what you assessed my property at and what you assessed my neighbor's property at, and they're similar, those are two different things. And because you assessed my property higher, I'm paying more taxes. You'd have to show that your assessed value is off, thus causing you to have higher taxes. Having higher taxes is a side note off of, hey, this needs to happen. Hey, LaRonda. Oh, and I see you chose D. Nice job, LaRonda. Nice job, everybody. All right. So before I go on to this new page, just checking in. Was there a topic? How do we feel about this? I'll continue to do questions till the cows come home. That's what I'm doing to prepare. But is there a topic or something you wanted me to go over because you needed a review? Just let me know. Just say it. Just throw it in the chat. You like this topic. Okay. But you like the questions. With questions, the topics go, roundabout. And I try to go into enough detail, but I can always do more. Right. Okay. 86. Capital gains is calculated using. Is it A, the depreciated basis? Yeah, I do too, Carla. I like it too. But then when somebody asks me if I can explain something like I know. I know. It's hard. I like questions. I do. It keeps it not on the same topic, keeps it from being too boring, too boring. Sorry, my phone is ringing and I just want to tell her I'll call this person right back because I need to talk to them. Hello, you're on Candid Camera. Hi, I'm doing a what do you call this? A webinar right now, but can I call you back in like 15 minutes? Okay, I'll call you back. Bye. A fellow instructor. But all right, going back to this. Oh, thanks, Trix. I appreciate you. Okay, capital gains is calculated using A, the depreciated basis, B, the original price of the property, C, the adjusted basis, or D, the capital gains basis. This is totally a vocab thing. Now, Amy said, look, our answer is C. She said, look, our answer is C. It's Candy Camera. Oh. It's not Candid Camera, it is Candy Camera. Y'all, side note, so I've been helping my friend's teenager, 10th grader, with Algebra 2. And I got read. This 10th grader read me for filth. I forgot what we were doing, and I was asking her to do something, or which one did she think felt like me? And she's like, I like that one because it's full of chaos, and you're just chaos. I'm offended that you are so correct about me. Yes, I am chaos in the greatest way possible. Just saying. But yes, our answer is adjusted basis. C for chaos, which is what I am full of. In the sweetest way. Because we know to find capital gains. To find capital gains, you take the adjusted basis. Remember, the basis is what you bought the house for. And then the reason we're saying it's adjusted is because you're adding in all those other costs that it costs, that you had to buy the house. And you're taking that amount and subtracting it from the amount realized. Now remember, and then that's going to give you your capital gains. Let's say you sell a house for $200,000, but after you pay the commissions, you walk away with $185,000. You're basically telling the government, look, I didn't actually make $200,000. I had to pay commissions and closing costs. I walked away with $185,000, but I bought it for $100,000. My adjusted basis, the money I put in to get the house was $100,000. So really, $85,000 is my new to me money. That's what you should base my taxes off of. What's new? All right. That makes sense, Caroline, now? Sound familiar? So the net would, oh, good. It does make sense. Yay. Okay. Not everybody will have this math, but everybody's going to need to understand these words, this amount realized, adjusted basis, and capital gains. And can anybody off the top of your head tell me, if you were selling your primary residence that you had lived in at least 2 out of the past 5 years, if you are single, how much can you get, capital gains exemption for? So single, it's your primary residence that you've lived at least 2 out of the past 5 years. How much can you say, hey, I'm not getting taxed on this part? Ooh, Amy says 200 or 250. Caroline says 150. She said it's one of the two. You're so Amy, you're right. It is if you are single. 250. And if you're married and filing jointly, it's 500. There you go. Love it. Love it. Okay. 87. A reason people invest in real estate is because real estate is fun, said no one who's actually an investor. But a reason people invest in real estate is because real estate is A, low risk, B, highly liquid, C, easy to manage, or D, highly leveraged. Ooh. Mm-hmm. Mm-hmm. And I got D's, and yes, our answer is D, highly leveraged. Well, let's make sure we understand what all these words mean. All investments are risk. All investments are risky. What happens if they decide to change the zoning and now there's a landfill next door? You're going to lose money. Like there's just risk there. It's not highly liquid because remember, liquid is how fast can you put your hands on the cash that is like the value of the house. If you have stocks, make a phone call in the next day or so, you can get your money. You can sell your stocks really quickly. But the money that's in a piece of real estate, you got to find somebody that wants to buy it, then you got to wait for closing. So it's not very liquid. And easy to manage, we're gonna, easy. I don't know any property managers that are like, oh yeah, it's easy. People are real people-y. So yes, our answer has to be D, highly leveraged. You are often using somebody else's money. Leverage is using somebody else's money or time to be able to do things. So there you go. All right. You said no way, Amy, to which one? Which part was no way? Oh, no way, easy to manage.
Yeah.
I had to stop and think about it.
You know my stories.
I mean, that's like saying kids are easy to have. I don't think so. I don't think so. Absolutely not. All right. 88. Real estate investors expect to make money all of the following ways except through how. So 3 of these are ways that you would make money, and one of them is not a way you make money if you're an investor. So I'm going to write that down. We got 3 are money happy, and 1 is going to be a sad money, no money. Is it A, tax benefits, B, staying liquid, C, capital appreciation, or D, positive cash flow? Ooh, I know what my guess is. A, tax benefits, B, staying liquid, C, capital appreciation, or D, positive cash flow. So I think here the key is make money. Which one of these doesn't actually make you worth more money or give you more money? All right. So tax benefits. If there is a write-off, are you getting more money? Well, yeah. If I made $500,000, but I don't have to pay taxes on 50,000 of it, that's a tax benefit. Well, then that $50,000 I made that's in my pocket. So yeah, that's not the answer. I would make money off of tax benefits. Staying liquid. Well, if I'm staying liquid, it means I have quick access to the cash. But did that make me money? Just because I have quick access to my cash, did I actually make money? That I'm not feeling too much. C, capital appreciation. Well, if the property is worth more money when I bought it, it was X, and now it's worth X plus some extra, then yeah, the appreciation means I've made money. So that's not our answer because you are making money here, you're making money here. And then a positive cash flow means the money coming in is greater than the money going out. So if I'm bringing in $5,000 a month, but what's going out the door is $1,500 loss each month, well, yeah, I'm making money. That's a positive cash flow. That's making me money as well, which means yes, our answer is B, staying liquid. All right. How we feeling about that? I see you, LaRonda and Trix, getting that answer right. I see y'all. Shaw. I see y'all. Mhm. I've liked this bank of questions. Oh, that reminds me, if you are in Michigan, and I know some of you all watch this later, but if you are in Michigan on Sunday, I'm going to do a live state specific review. I know my handwriting's awful, but Sunday afternoon, I'll pick a time, but I'm going to do a live state specific review. It won't be live on YouTube. It'll probably be live just via Zoom, but anybody is welcome to come. It is free. It's just a way for me to practice my Michigan stuff before I take my licensing exam. So, and in case you're watching this later, today is Wednesday, December 3rd. So you do the math and tell me what Sunday's date is. That's beyond my brain power right now. All right, 89. When calculating the adjusted basis for capital gains purposes, depreciation is. So when calculating the adjusted basis for capital gains purposes, so this comes back to what we had up here. You got your amount realized and you take from that your adjusted basis that gives you your capital gains. So when calculating the adjusted basis, what you put into the property for capital gains purposes, depreciation is it A, subtracted from the total cost of the property, B, subtracted from the value of the building only, C, added to the adjusted basis, or D, subtracted from the taxes due? Ooh, I will be impressed if you get this. Calculating the adjusted basis. Depreciation. Actually, I'm going to have to disagree on this one. What do you all think? Anybody? Well, I said to you all earlier, the adjusted basis is the money that you bring in, that you put into the property. So I would say it's not from the total cost of the building, subtracted from the value of the building only. Well, yeah, remember, land doesn't depreciate. So maybe added to the adjusted basis. Well, no, it's not added to the adjusted basis. We're not saying, oh, it depreciated, so you should give me more money. And subtracted from the taxes due. Well, you're right, Merle. You do have to subtract. Right. Caroline, you said A, subtracted from the total cost of the property. LaRonda, you said A. Now, I will tell you, now that I have the answers, they're telling me the answer is A, subtracted from the total cost of the property. But then it goes through and I read, depreciation is subtracted from the total cost of the property. For instance, purchase price plus capital improvements to get the adjusted basis. Remember that depreciation is calculated only against the value of the building. Buildings depreciate, but land doesn't. So I feel like that answer contradicts what they're saying, right? Because their answer says, hey, it's only, you only deduct depreciation from the building only. But then it told us that the answer is subtract from the total cost of the property. The only, I don't like this. I don't like this. This is the only way I think this could be true. You only have to do capital improvements to a property. So when you're finding adjusted basis, that is take what your sales price, what you bought it for, or your purchase price, and you're adding your closing cost and you're adding what's the word I'm thinking of you're adding capital improvements. Meaning, if I bought the house for $100,000 and then I had $5,000 in closing costs, but then I added a new bathroom and that was $20,000, then my adjusted basis would be $125,000. In theory, you could say, well, the reason you're doing capital improvements is because you are, it, it's out of date, it's depreciated, and you want to bring it back up. I mean, I could see how A could be the answer there, but I think a better answer would either be B, because you're saying, hey, if there is depreciation, it's only going to the building. But I actually think D is the best answer, because if you're going to be taking off for depreciation, if it's not your personal residence, that's usually coming off of what you pay the IRS. So after you figure out your capital gains, if you're going to do that. But again, that's tax stuff. I would have either said B or D before I said A, but hey, right? Like I'm okay not knowing this one. I feel like it's B. I feel like B is the better answer since that's what they said in the question. But that's okay, because all of our other questions have rocked. So if we just didn't get this one, it's fine. All right, let's do one more. Nande. In analyzing a possible real estate investment, potential gross income minus vacancy and collection loss minus operating expenses equals what? So when you take your potential gross income, your potential gross, and you subtract vacancies and subtract collection losses, that gives you your effective gross income. And if you take out of that your operating expenses, that gives us our NOI, our NOI. And with that, boys and girls, we have ending on a good note. Remember, if you want to join me on Sunday, I mean, I'll be breaking down the questions. It's going to be Michigan specific stuff. You're more than welcome to just shoot me an email and say, hey, Candace, can I get the Zoom link for that? Otherwise, I will be back here on Friday at 3 p.m. And I think that's it. Congratulations to my people who passed. Woo, woo, do, 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 do. To my people who passed. And I will see everybody later. Stay safe this holiday season. And by that, I mean, don't get trampled in a store.
Thank you,
Please don't.
Candace. Have a good evening.
You're welcome, Miss Caroline. Bye. Bye, everybody.